Ladies and gentlemen, we got Zoom stock, or it looks like doom stock. It's doom and gloom. This is not Zoom today. What's going on? Things down 11.5% after hours. After a good performance in the actual day cycle of trading, up 2%, and then, we're talking about nearly 12% drop after hours. They just reported earnings, so it's going to be something we look at. Has fallen now down to the near $300 level. So one thing you need to consider is the performance of the stock certainly can be an indicator of earnings results, really. So obviously the numbers they post might not be relevant to what the stock does, depending on how the stock's performed historically. Only really up 7% in the last year is not crazy at all. But really, if you look a little bit further out, you see the massive performance here from 2020 onward. So from 2020, we're talking about a 416% increase in the span of a year and a half. So the stock's up massively in a very short period of time. So it's part of it. Don't listen to this weird jump here. That doesn't exist. But just think of that being part of it. I did expect a beat on both aspects here in terms of Zoom. And I really expect quite a bit out of this company. As far as guidance as well, it's facing incredibly tough comparables because last year we're facing a time in which all these corporations were forced to go to Zoom meetings as opposed to their typical in-person meetings. But where the benefit lies for Zoom is that work from home is going to stick around, and you're going to get a lot of clients that like the service and prefer it to physical meetings and will continue to work with them. So in my perspective, I expected better guidance. Well, let's just look. Let's see what we got here for Zoom. So, quarter two GAAP EPS of $1.36 is a beat by 20 cents, and a GAAP EPS of $1.04 beats by 24 cents. That's nice. I mean, I don't see anything bad with that. And when you're looking from a revenue standpoint, a growth of 53% year over year, still off of a massive year. It's a beat by 29 million. I did expect them to cross over the $1 billion mark, and I thought that would have been enough for Wall Street to be, pretty happy with it. But apparently it wasn't. They were playing at, right around 999 million, and I thought they would beat, put over the 1 billion mark, and they didn't. Apparently that wasn't enough. Shares are getting hammered. Some of the finer details: customers contributing more than 100,000 in trailing 12-month revenue increased up 131% year over year. So again, you're getting big clients here. I'm not seeing the negative yet so far. Operating margin of 28.8. I mean, that's all good. All things considered, free cash flow at 455 compared to 373. So growth in that aspect as well. Let's check on Outlook. Outlook expected 1.01 billion to 1.02 billion compared to a consensus of 1.01. So they raised in terms of guidance there. And a non-GAAP EPS of $1.07 to $1.08 versus a consensus of $1.09. So it's a little bit lighter in that aspect. But if you look for the full year, the revenue is expected above consensus, and EPS is expected above consensus, 475 to 479, when the consensus was 466. So next quarter, they're expecting a little bit lesser in terms of profit, and I really don't believe that's the only reason why this thing's down. I think it'd be very short-sighted if that was the reason why this is down. I think there are many other reasons for it. I would definitely want to consider valuation as part of it too. You look at Zoom stock, this is still a stock trading at a $100 billion market cap, yet this is a company that's bringing in this year just probably right around $4 billion is what the expectations are for them. So they're trading at a $100 billion valuation with $4 billion of revenue. So that's one thing to consider. I think that's part of why we see this dip today. And they're trading at a very high PE ratio, over 100. So the stock's valued very, very highly, and I think that's part of it. So they would have had to incredibly beat expectations to see the stock continue to rise. So I think this is just a little bit of the market catching up with the stock that's gotten a little hot. Let's look at the press release, look at some good stuff here in terms of balance sheet. But I really like this customers contributing over $100 million or $100,000 in trailing 12 months. I like that quite a bit. Because that's a number they're going to want to continue to increase, because you talk about big corporations utilizing Zoom as partnerships. That's really where they're going to make a lot of their money. It's not from you and I getting on Zoom. They're getting their money from big corporations, signing deals with them, and using Zoom as their preferred meeting platform. And that's what they need to really focus on and continue to get that. So net income line, came in at 316 million, which is up from 184 or 185 million. So great from the year prior. I mean, again, I see great things out of this so far. Yeah, I mean, what can I say? So far, I don't know. Approximately 504,000 customers with more than 10 employees, which is up 36%. It's good to see in that aspect too. I mean, you know what? It looks good. The outlook looks good. Let's look at the press release as our balance sheet. My favorite thing to look in terms of the financials of a company. This is what I love digging into, baby. Let's look at the total current assets here. They're giving you a 6 months comparison, so a little bit of a shorter term. I prefer a full year, but that's okay. Sitting at $5.8 billion in total current assets compared to 4.7 of 6 months ago. You see marketable securities has increased quite a bit. My assumption is they're probably going to sell that off for a cash position in the future. Total assets in general sitting at 6.5 compared to 5.2, most of that being the current liability growth. Liability or current asset growth. Liabilities, current liabilities sitting at 1.6 compared to 1.2. And as a whole sitting at 1.8 to 1.4. So actually stockholder equity rose by a decent amount here in a 6 month span. 4.6 billion to 3.8. And this is an incredibly high margin business when all things get flowing super well with them. So this is a company that should have a good balance sheet already. And if they already do have a good balance sheet, I like the future of this company's balance sheet, really. As I said before, my concern here is in terms of valuation. I think this is a stock that's valued a little too high right now still. Under 300 is definitely more manageable of a dip here. We're talking about lowering the market cap closer to 90 billion. Still pretty expensive for a stock trading at where it's at. I mean, what can I say? It'll be trading at a market cap right around 90 billion. Yet the company's still only going to make 4 billion this year, and next year likely 6 billion as well with its 50% annualized growth. So it's tough to say. I don't know. I don't think the stock's a buy at this level. I think there needs to be a bigger pullback, and I was waiting for a pullback for quite a while, but I think it just got a little too hot for its own good. I think the stock's better right now around the 250 range off the initial bump that it saw in 2020. I think it's better around where it was in July of last year, frankly. That's what I got for you, and I hope you have a good one. Let me know your opinions as well.